A company asks a private credit fund for a $60 million loan. The return looks attractive: 8% cash interest, 3% PIK interest, a 2% upfront fee, first lien security, and an LTV of only 50%. Would you approve it? Most people say yes too quickly because a high return and a first lien do not automatically make a good loan. Let's test the deal like an interviewer would. The company is worth $120 million and produces 15 million of EBITDA. It wants to borrow 60 million, so debt to EBITDA is 4 times and LTV is 50%. LTV means loan to value. It asks, how much debt sits against the value supporting the loan? At 50%, the lender appears to have a cushion, but value is only one side of the story. The borrower still needs cash to pay interest and repay debt. That is where DSCR matters. DSCR means debt service coverage ratio. It asks whether operating cash flow is enough to cover scheduled interest and principal. In our case, DSCR is 1.6 times. That sounds comfortable, but remember the difference. LTV measures collateral protection. DSCR measures repayment capacity. A borrower can have valuable assets and still struggle to make payments on time. Now look at the structure. Assume this is a senior secured unitranche loan. Unitranche means one facility combines risk that might otherwise sit in separate senior and junior tranches. Senior secured means the loan is backed by agreed collateral. First lien means this lender stands ahead of junior lenders in the repayment queue. But first lien does not mean guaranteed recovery. The collateral may lose value, legal enforcement may take time, and other claims may reduce what is ultimately recovered. The loan has a 5-year maturity. A small part of principal amortizes during the term. Most of it is due at the end as a bullet repayment. That keeps early cash payments lower for the borrower, but it also leaves more principal outstanding near maturity. There is also a 50% cash flow sweep. If the business generates excess cash, half of it must be used to repay the loan early. For the lender, that reduces risk. For the borrower, it reduces flexibility. Now the covenants. Think of covenants as warning signals, not just legal clauses. The borrower may need to maintain a minimum DSCR, stay below a maximum leverage level, provide regular reporting, and avoid taking additional debt without approval. A covenant breach can alert the lender before an actual payment default occurs. Now let's talk about the 11% headline return. The cash coupon may be quoted as SOFR plus 650 basis points. For this example, assume that produces roughly 8% cash interest. 8% is cash interest that can create an interest receivable and interest income. 3% is PIK interest. PIK means payment in kind. Instead of receiving cash, the lender adds the interest to the loan balance, so the asset grows. Income may be recognized, but no cash enters the fund. That is a major private credit accounting trap. Return recognized is not always cash received. The 2% upfront fee creates another question. Is it immediate income? Is it deferred and amortized? Does it adjust the loan's effective yield? The answer depends on the nature of the fee and the applicable accounting policy. At origination, the basic funding entry may be debit loan investment 60 million, credit bank 60 million. The fund has exchanged cash for a loan asset. It has not recorded an expense. For cash interest accrual, debit interest receivable, credit interest income. For PIK interest, debit loan investment, credit PIK interest income. Cash interest can increase income and NAV. PIK can also increase income and NAV while producing no cash. That is why a reviewer cannot stop at the income number. They must ask how much of the return is cash, how much is PIK, and how recoverable the total balance really is. So would you approve this loan? At this point, maybe. The structure looks strong, the collateral cushion appears reasonable, and current cash flow seems able to service the debt. Then EBITDA falls from $15 million to $10 million. The interest rate has not changed. The borrower has not missed a payment, and the loan still says first lien. But has the fund already lost value? That is where the real private credit judgment begins. EBITDA has fallen from $15 million to $10 million. The loan is still $60 million. So debt to EBITDA has moved from 4 times to 6 times. Nothing changed in the legal document, but the economics changed immediately. Many candidates wait for a missed payment before recognizing deterioration. Private credit risk often appears earlier. Start with DSCR. With lower cash flow, the borrower has less room to cover interest and principal. The exact ratio depends on the agreement's cash flow definition and scheduled debt service, but the cushion has weakened. Now check the covenants. If maximum leverage was 5 times, 6 times could create a breach. If minimum DSCR was 1.5 times, the borrower may be near or below the threshold. A covenant breach is not the same as a payment default. A payment default means an amount due was not paid. A covenant breach means an agreed protection was violated before any payment is missed. That may allow the lender to reprice the loan, demand more reporting, restrict distributions, obtain extra collateral, or begin restructuring discussions. Now the accounting question. Should the fund continue recognizing cash and PIK interest exactly as before? Contractual interest may still accrue, but recognition depends on collectability, valuation policy, and the applicable framework. PIK deserves special attention. It adds income and increases the loan balance, but no cash is received. When credit weakens, the reviewer must ask whether that growing balance is recoverable. A loan can show rising interest income while its economic value is falling. That is the central private credit paradox. Now consider valuation. The loan may originally have been valued near $60 million. After deterioration, investors may demand a higher return for the same risk. Expected recovery may decline and collection may take longer. As required yield rises, fair value can fall. A possible entry may be debit unrealized loss, credit loan investment, or valuation adjustment. Account names vary by policy and system. The write-down reduces P&L and lowers fund NAV. Here is the interview trap. Interest income may increase NAV. A valuation loss may reduce NAV. Both can happen in the same reporting period. The reviewer must explain the net movement, not just one entry. Suppose the borrower still pays cash interest. Debit bank, credit interest receivable. That clears the receivable. It does not recognize the income again because the income was recorded when accrued. Now suppose 5 million of principal is repaid. Debit bank 5 million. Credit loan investment 5 million. Principal repayment is not automatically income. It converts part of the loan asset back into cash. Now imagine the borrower cannot meet the original terms. The lender may enter a workout. That could involve extending maturity, increasing the spread, adding PIK, resetting covenants, receiving new collateral, taking a partial repayment, converting debt into equity, or accepting a write-down. A restructuring is not automatically good news. A higher rate means little if the borrower cannot pay it. More PIK can grow the balance while delaying cash. An extension may improve short-term liquidity while increasing recovery risk. Now separate junior execution from senior judgment. The junior should reconcile principal, accrue cash and PIK interest, record fees under policy, post collections and repayments, update loan schedules, tie the investment ledger to the general ledger, and use the approved valuation. The senior should ask, is continued accrual appropriate? Is PIK recoverable? Was the covenant breach identified? Does valuation reflect current risk? Should the loan move to non-accrual? And can investor reporting explain why income rose while NAV fell? For an interview, use this 5-step framework. First, understand the structure and repayment terms. Second, measure leverage, DSCR, collateral, and lien priority. Third, separate cash interest, PIK, fees, and principal. Fourth, assess covenant breaches, collectibility, default risk, and valuation. Fifth, connect every conclusion to P&L, NAV, and investor reporting. So, would you approve the original $60 million loan? The honest answer is not yes or no from one ratio. At origination, the deal may have looked acceptable. After EBITDA falls, the same loan requires a different judgment. The interest rate tells you the promised return. The structure tells you how the lender is protected. The accounting tells investors what the loan may actually be worth today. Search the Fund Desk on YouTube for the Private Credit Interview Bible.